Hi there, and welcome to this Expert Insights video with Simon Mullumby, the head of Australian cash and bonds at State Street Global Advisors. Inflation has been the topic du jour for some time today, so let's speak with Simon around what the outlook is as we move towards 2024. Inflation, it was meant to be transitory, sticking around a little bit longer. What are your expectations as we look out to 2024 for both Australia and the US?
Higher for longer, and it's proven to be very sticky. So where the central banks have obviously got this explicit inflation mandate where if they can control inflation and can keep it within their explicit bands, the belief is that they can then control growth and employment. And at the moment, inflation is miles above where it should be, which is understandable given the stimulus that was put into the global economy during the COVID period. But the belief is that inflation is still markedly higher than where it should be, and it's not transitory. It is certainly sticky, and that's what a lot of the central banks are signalling at the moment, in that it's just not falling to the degree that they would like it to, given the tightening that's been delivered globally. So in answering your question from the US, and in particular from the domestic front in Australia, the central banks will have to do more.
Why do you think it's been so hard for central banks to combat this inflation?
Look, I think because the central banks are going about it in a very different manner. They've become increasingly transparent. They've become increasingly cognizant of people with a lot of leverage. They've become increasingly aware that markets do hang on what they say. And they're also aware that given the stimulus that they put into the economy, global economy over the last 3 years during the COVID period, that to a degree it's their fault that things are roaring the way they are, but also central banks like inflation. They don't like high inflation, but they do like controlled, steady increases in prices year in, year out. And the RBA tried to drive inflation for 10 years and they weren't successful. Now they've got it. They've just got to learn to control it. They don't want to stamp it out. They don't want to just smash everything to get inflation back within the band. So they're going about it with kid gloves, and I think that's why it is proving stickier, but they'll control it. There's no two ways about it. Just maybe it's going to take a little bit longer and maybe higher rates than where we are at the moment.
Against that higher inflation backdrop, what are some alternatives to cash that can provide some protection against that higher inflation without giving up all of the stability or the protection that cash offers?
Yeah, look, I mean, the description cash describes a lot of notes in the Australian money market.
Well, why don't I talk about it more from the person on the street? Yeah. Cash, dollars in a bank account. What's the next step along what are some of the close to alternatives that can provide a bit more protection against that inflation?
Yeah. High quality bank names, highly liquid bank names, and we are a big fan on the desk of floating rate notes. And the reason we like floating rate notes is that if we do see more tightening from the Reserve Bank of Australia, the note that resets every 3 months will deliver a coupon markedly higher than the cash rate, yeah, and also is a very short interest rate duration. So the reason they're called floating rate notes is the coupon resets every 3 months. They float over the BBSW curve, and if duration's your risk, and if there is going to be inflation which is higher for longer, and if the Reserve Bank of Australia is going to tighten rates further, you want your interest rate duration to be a lot shorter because that mitigates your risk. So that's why we prefer in our portfolios floating rate notes.
Your fund only focuses on Australian and Australian dollar dominated assets. Yep. Why is that?
It's a great question, and the reason that we have deliberately only mandated ourselves to buy Aussie dollar assets and to only buy Aussie dollar banks, so international banks that issue in Aussie dollars too, is so that we're not running the derivative overlays, so that we're not running swaps, we're not hedging any exposure. Yes, there's a lot more exposure you could garner from being offshore and then moving it back to an Aussie space, but when the market does become very volatile, and when you do start making margin calls and rolling hedges and swapping interest rate exposures in a volatile market, we firmly believe that adding these extra dynamics to a very conservative liquidity-based portfolio at times is a bit more trouble than what it's actually worth. So we deliberately stick to the very conservative, senior unsecured Aussie dollar bank space, which includes both domestic banks and international banks, but only ones that issue in Aussie dollars.
Yep. So let's bring it back to inflation, which is where we talked about. The backdrop is far different to what it has been in recent history.
Yep.
Is that a good thing or a bad thing for the markets that you invest in?
Look, I mean, if we continue to see inflation stay well above the band that it needs to be in, which is 2 to 3% for the RBA, that's going to make it tough for the fixed income market. Obviously, bonds are priced off a yield curve, and that yield curve will continue to move north as inflation sticks around for longer. As central banks continue to raise interest rates, it will all continue to shift north. It'll only go inverted, and it was inverted 4 or 5 months ago, based on the fact that people were believing that the central banks were going to go too hard and it was going to be a recession and the growth situation was gone. That's proven not the case, which is why we've seen this substantial sell-off in the last several months. But to your question, you know, if inflation does hang around for longer, you're going to see more from the central bank insofar as tightening, and you're going to see longer dated yields continue to move higher as inflation is priced in across the curve.